Dividends constantly hitting your account to fund your lifestyle. That is the dream for many investors. The idea of being paid simply for holding on to your investments, watching that cash roll in. But what if I told you there is another way? A way that could potentially be even more profitable. Today, I will be comparing that dividend dream with the idea of trimming your positions instead to fund your lifestyle. And to help explain this, I will walk you through a straightforward example from Warren Buffett himself. The example is more about companies deciding to pay dividends or not rather than the investors, but it all comes down to the same result. It might sound like a lot of numbers, but trust me, it's simpler than you would expect. So let's break it down. Imagine you own 50% of a $2 million company, along with one other partner who also owns the remaining 50%. This company generates a 12% return or $240,000 in annual earnings. Also, this company can always be sold at 125% of its value. So even though the company is worth $2 million, you can sell it for $2.5 million at any given time through the market. This means that for both you and your partner, your stake is really worth $1.25 million each, thanks to the market premium. Now, in the first case, let's say the company pays out 1/3 of its earnings as dividends, $80,000 in total, while reinvesting the other 2/3 or $160,000 back into the business. Each of you, as owners, receives $40,000 in dividends annually. After 10 years, thanks to compounding at an 8% annual rate, which is the 12 minus the 4% dividend payout, the company grows in value to $4.3 million. That means by year 10, you are receiving $86,000 in dividends annually, and your stake at 125% is worth $2.7 million. Not too bad, right? So with this strategy, you have received dividends over time and grown the value of your holding through reinvestment. But now, let's look at the alternative. Instead of receiving dividends, what if you left all the earnings in the company and sold 3.2% of your shares each year to fund your lifestyle? In this case, the company continues to grow at the full 12% rate without any cash being taken out for dividends. You start by selling $40,000 worth of shares in the first year, same as you received from dividends in the previous scenario. After 10 years, the company's value has grown to $6.2 million. And even though your ownership has dropped to 36.12%, the value of your remaining stake at 125% is still worth $2.8 million. That is a 4% higher return compared to the dividend scenario. By selling shares instead of relying on dividends, you have managed to extract more value over time. Of course, there are a lot more to consider, like the tax situation and so forth, but this very basic example, in my opinion, should broaden your horizons to non-dividend paying companies as well as the dividend paying ones for your retirement portfolio. However, I am also aware of the opportunity cost. The mental benefits of the dividends can be much more preferable for some investors rather than constantly keeping a watchful eye on the company's trajectory, and since I can't put a price on that peace of mind, you can actually say that dividends are the better alternative despite these numbers and be right about it. So what's the takeaway here? While dividends are often seen as a stable and reliable way to fund your lifestyle, selling shares might actually provide a better long-term outcome if the company is growing consistently. Warren Buffett's example highlights that selling a portion of your shares could be a smarter strategy than simply sitting back and collecting dividends, especially if your company is reinvesting its earnings effectively. It all comes down to personal preference, but the key message is clear. Don't overlook the power of selling shares as a way to fund your lifestyle. Sometimes the less obvious path can lead to better results. And that was it for today's video. You can check my Patreon for my deep dives and updates on the companies that I personally follow and invested in, all while supporting the channel. Other than that, I'll see you in the next one.